In the bustling world of finance, banks often present themselves as the guardians of your wealth, promising security and growth. However, beneath this polished facade lies a web of misleading narratives designed to keep you complacent while they profit. Let's unravel some of the biggest lies your bank tells you and arm you with the knowledge you need to navigate your financial future wisely. One of the most pervasive myths is the idea that your money is genuinely growing in your bank account. Banks love to showcase interest rates that seem attractive, leading you to believe that your savings are flourishing. Yet the reality is starkly different. While your account balance may increase incrementally, the purchasing power of that money is eroding due to inflation. Imagine this. You have $1,000 in your savings account earning a modest interest rate of 1%. In a year, you might see that balance rise to $1,010. However, if the inflation rate is 3%, that same amount of money can only buy what $970 could have purchased a year prior. The illusion of growth is shattered when you realize that your savings are not keeping pace with the rising cost of living. This disconnect between nominal gains and real-world purchasing power can significantly hinder your long-term financial goals, be it retirement, education, or homeownership. Another common myth is the notion that your bank has your best interests at heart. Banks are businesses, and like any other, their primary goal is profit. They often market their products as beneficial to you, but in many cases they prioritize their bottom line over your financial health. Consider the fees associated with your bank account. Monthly maintenance fees, overdraft charges, and ATM fees can add up quickly. While these fees may seem minor at first glance, over time, they can siphon away significant portions of your hard-earned money. It's crucial to scrutinize these charges and seek out accounts that minimize fees or offer greater transparency. Remember, your bank is not a charity. They are incentivized to maximize their profits, often at your expense. Furthermore, banks often tout the safety of their savings accounts as a reason to keep your money within their walls. Yes, your deposits may be insured up to a certain limit, but that doesn't mean your savings are immune to risk. The real danger lies in complacency. By keeping all your funds in a traditional savings account, you may miss out on opportunities for higher returns elsewhere. Diversifying your investments, whether through stocks, bonds, or real estate, can lead to more substantial growth over time. It's essential to educate yourself about different investment vehicles and understand that while banks may promote their savings accounts as the safest option, they might not be the best choice for wealth accumulation. Another lie that banks perpetuate is the idea that credit cards are essential for building your credit score. While it's true that responsible use of credit can positively impact your credit history, many banks encourage you to accumulate debt under the guise of building credit. They often promote credit cards with enticing rewards and cash-back offers, but these come with high interest rates that can trap you in a cycle of debt if not managed carefully. The key to building a healthy credit score lies in using credit wisely, keeping balances low, making payments on time, and avoiding unnecessary debt. Banks may not emphasize this message as much as they should because they benefit from the interest payments on your outstanding balances. Moreover, banks frequently mislead customers about the ease of obtaining loans. They often advertise loans as accessible and straightforward, but the fine print tells a different story. While the allure of quick cash can be tempting, many borrowers find themselves ensnared in unfavorable terms, including high interest rates and hidden fees. The process can be convoluted, with banks often prioritizing their interests over those of the borrower. Before taking on any loan, it's vital to read the terms carefully, compare offers from multiple lenders, and fully understand your financial obligations. Another significant misconception is the idea that having a bank account is synonymous with financial literacy. Just because you have a bank account doesn't mean you understand how to manage your finances effectively. Banks often promote financial products without providing adequate education on how to use them wisely. This lack of financial literacy can lead to poor decision-making, resulting in missed opportunities for savings and investment. It's essential to take charge of your financial education. Read books, attend workshops, and seek advice from knowledgeable sources. Empowering yourself with financial knowledge will enable you to make informed decisions that align with your long-term goals. Lastly, let's not forget about the myth of loyalty. Banks often reward longtime customers with special offers, leading you to believe that staying with one institution is beneficial. However, loyalty can sometimes blind you to better opportunities. The financial landscape is constantly evolving, with new banks and credit unions emerging that offer competitive rates and innovative products. Regularly reassessing your banking options can lead to significant savings and improved financial outcomes. In conclusion, while banks play a crucial role in managing our finances, it's vital to approach them with a critical eye. The biggest lies your bank tells you can lead to complacency, missed opportunities, and financial stagnation. By understanding these misconceptions and taking proactive steps to educate yourself, you can protect your wealth and make informed decisions that align with your financial aspirations. Don't let the polished marketing of banks dictate your financial future. Take control, seek knowledge, and pave the way toward true financial empowerment. The notion that cash is the safest investment is a comforting lie perpetuated by financial institutions. It plays into our desire for security, suggesting that if we simply hold on to our money, we are protecting ourselves from the uncertainties of the economy. However, this belief is fundamentally flawed. The reality is that cash, while liquid and readily available, is one of the worst long-term investments one can make. Over time, inflation erodes its purchasing power, turning what once felt like a safe haven into a depreciating asset. Consider the implications of inflation. $100 today will not buy you the same goods and services it would have 20 years ago. In fact, due to inflation, the purchasing power of $100 in 2003 is roughly equivalent to about $160 today. This means that holding onto cash is akin to watching your wealth slowly evaporate. Instead of providing security, cash can become a liability, losing value while you wait for opportunities to invest or grow your wealth. So, if cash is not the safe investment it's touted to be, what alternatives exist? Fortunately, there are numerous assets that not only preserve value, but also have the potential to grow, even in the face of economic uncertainty. Let's explore 6 such assets that can help protect and enhance your wealth. First on the list are precious metals: gold, silver, and platinum. These metals have served as a store of value for centuries, with their worth deeply embedded in human history. Unlike paper money, which can be printed at will, precious metals are finite resources. For instance, an ounce of gold that cost around $40 in the 1950s is now valued at over $2,000 in 2023. This staggering increase of 400% exemplifies how precious metals tend to appreciate during inflationary periods. Investing in physical gold and silver can be daunting due to storage concerns. But there are alternatives. Gold exchange-traded funds, ETFs, allow investors to gain exposure to the price movements of gold without the need for physical storage, providing a cost-effective way to benefit from this timeless asset. Next, we turn to industrial commodities. Materials like silver, cobalt, nickel, and copper are not merely valuable. They are essential for modern technology and industry. Silver, for example, plays a crucial role in electronics and medical equipment, while cobalt is vital for battery production. As the demand for electric vehicles and renewable energy sources grows, so too does the need for these commodities. Investing in mining companies or futures markets can provide exposure to these essential materials without the hassle of physical storage. The price of cobalt has surged since 2020, reflecting its increasing importance in the green energy sector, a trend expected to continue as the world shifts towards sustainable practices. Real estate is another powerful asset class that offers both protection and growth potential. Unlike cash, which loses value over time, real estate typically appreciates, providing a hedge against inflation. Whether through rental properties or real estate investment trusts, REITs, real estate allows investors to benefit from both property appreciation and rental income. In many markets, property values have seen significant increases, driven by factors such as population growth and urbanization. Investing in real estate not only offers the potential for long-term capital gains, but also provides a tangible asset that can generate cash flow. Next up is the world of stocks, which historically have outperformed cash over the long term. While the stock market can be volatile in the short term, the long-term trend tends to favor growth. Investing in a diversified portfolio of stocks allows you to participate in the growth of various industries and companies, effectively hedging against inflation. Index funds and exchange-traded funds, ETFs, offer a straightforward way to gain exposure to the stock market without the need for extensive research or stock-picking skills. Over decades, the stock market has consistently returned more than inflation, making it a compelling option for those looking to grow their wealth. Bonds also play a vital role in a well-rounded investment strategy. While they may not provide the same growth potential as stocks, bonds can offer stability and income, particularly in uncertain economic times. Government and corporate bonds can serve as a buffer against stock market volatility, providing a steady stream of interest payments. Additionally, certain bonds, such as inflation-protected securities, are specifically designed to safeguard against inflation. ensuring that your investment retains its purchasing power over time. Lastly, consider alternative investments such as cryptocurrencies. While often seen as speculative, cryptocurrencies like Bitcoin have emerged as a new asset class that can offer significant growth potential. As more institutions and individuals adopt digital currencies, their value has soared, presenting an opportunity for investors willing to navigate the volatility. Cryptocurrencies can serve as a hedge against inflation and currency devaluation, particularly in times of economic turmoil. In conclusion, while cash may feel like the safest investment, it is essential to recognize its limitations. The erosion of purchasing power due to inflation makes cash a poor long-term strategy for wealth preservation. Instead, consider diversifying your portfolio with assets that have a proven track record of growth and protection against inflation. Precious metals, industrial commodities, real estate, stocks, bonds, and alternative investments each offer unique benefits that can help you not only safeguard your wealth, but also grow it in uncertain times. By making informed investment choices, you can build a more secure financial future. Land and real estate have been the bedrock of wealth accumulation for centuries, and their importance continues to resonate in today's ever-evolving economic landscape. As the global population expands, the demand for land, whether for residential, agricultural, or commercial purposes, grows in tandem. This relationship between land and population is not merely a trend, it is a fundamental principle of economics that has stood the test of time. Consider the trajectory of housing prices over the last few decades. Between 1992 and 2020, housing prices experienced a remarkable tripling, despite the significant downturn caused by the 2008 financial crisis. This resilience underscores the inherent value of real estate as an asset class. While markets may fluctuate and economies may face challenges, land and property often emerge as stable investments that can weather the storm. The underlying reason for this stability is simple. Land is finite. As more people seek places to live, work, and conduct business, the demand for available land only intensifies. For those who may feel daunted by the prospect of purchasing property outright, there are alternative pathways to invest in real estate that require less capital and management. Real estate investment trusts, REITs, serve as an excellent entry point for investors looking to dip their toes in the real estate waters without the burdens of property management. REITs allow individuals to invest in portfolios of real estate assets, providing them with the opportunity to earn dividends and benefit from property appreciation without the need to physically manage the properties themselves. This democratization of real estate investment opens doors for many who might otherwise be excluded from this lucrative market. Moreover, rental properties present another viable option for generating passive income. Investing in rental properties can yield a steady stream of cash flow, as tenants provide regular rent payments. This model not only offers the potential for immediate returns, but also allows for long-term appreciation of the property value. While managing rental properties does require some effort, such as maintenance and tenant relations, the rewards can be substantial, particularly in high-demand areas where rental markets are robust. As we explore the world of investments further, it becomes clear that real estate is not the only avenue for wealth accumulation. Collectible assets, often overlooked in traditional investment discussions, can also serve as incredible stores of value. Items such as classic cars, rare art, and limited edition luxury goods have a unique allure that transcends their monetary worth. They are not just investments, they are tangible pieces of history that resonate with collectors and investors alike. Take for instance the extraordinary sale of a 1955 Mercedes-Benz 300 SLR, which fetched an astonishing $135 million in 2022. This sale not only demonstrates the potential for appreciation in collectible assets, but also highlights the emotional and cultural significance that can accompany such items. Collectors often view these assets as more than mere investments. They represent a passion, a connection to a bygone era, and a testament to craftsmanship and artistry. Similarly, the art market has seen staggering prices for rare pieces, with Leonardo da Vinci's Salvator Mundi selling for hundreds of millions of dollars. These artworks are not just financial assets. They are profound expressions of human creativity and history. The appreciation of art over time is often fueled by its rarity, provenance, and the narrative surrounding the artists. Investing in art can be both financially rewarding and personally fulfilling as collectors find joy in owning and appreciating these masterpieces. The allure of collectible assets lies in their dual nature. They are investments that can appreciate over time while also offering aesthetic and emotional satisfaction. This unique combination makes them an attractive option for diversifying an investment portfolio, allowing individuals to hedge against market volatility and inflation. As we consider the various avenues available for wealth accumulation, it becomes evident that both real estate and collectible assets offer unique advantages. Real estate provides a stable, tangible investment that can generate income and appreciate in value, while collectibles offer the potential for significant returns rooted in cultural and historical significance. In a world where financial institutions often prioritize their interests over those of the consumer, understanding these alternative investment strategies is crucial. The traditional banking system may not always provide the best guidance for individuals seeking to build and protect their wealth. By exploring options like real estate investment trusts, rental properties, and collectible assets, individuals can take control of their financial futures and make informed decisions that align with their goals. Ultimately, the journey toward financial empowerment is a personal one, shaped by individual preferences, risk tolerance, and long-term objectives. Whether one chooses to invest in real estate or delve into the world of collectibles, the key is to remain informed, adaptable, and open to exploring new opportunities. As we navigate the complexities of modern finance, let us remember that the most valuable investments are those that resonate with us personally, that align with our values, and that contribute to our overall well-being. By embracing these timeless assets, we not only protect our wealth, but also enrich our lives with experiences and stories that will last for generations. So, as you consider your financial future, think beyond traditional banking narratives and explore the vast landscape of investment opportunities available to you. Whether it's through real estate or collectible assets, the potential for growth and security is within reach. Let's take control of our financial destinies together, ensuring that we are not just passive participants in the economy, but active architects of our wealth. In a world where financial institutions wield immense power over our lives, it's crucial to peel back the layers and expose the truths they often keep hidden. For too long, many of us have been lulled into a false sense of security, believing the comforting words of our banks without questioning their motives. But now, armed with knowledge and insight, we can navigate this complex landscape with confidence and clarity. Consider the common narrative that banks promote: the idea that saving in a traditional savings account is the best way to secure our financial future. They tout the safety of these accounts, often adorned with enticing slogans about interest rates and stability. Yet, the reality is starkly different. With inflation steadily eroding the value of our money, the paltry interest rates offered by banks can hardly keep pace. Instead of growing our wealth, these accounts often serve as a stagnant pool, where our hard-earned money lies dormant, losing purchasing power day by day. But it doesn't have to be this way. There are alternatives, assets that can not only protect our wealth, but also help it flourish. Investing in stocks, real estate, or even precious metals can yield far greater returns than any savings account ever could. Each of these assets comes with its own set of risks and rewards, but the potential for growth is undeniable. By diversifying our investments and educating ourselves about market trends, we can transform our financial futures from passive to proactive. Moreover, let's talk about the myth of too risky. Banks often paint a picture of investing as a perilous gamble, something only the daring should attempt. This narrative can be disempowering, making us feel like we should leave our financial decisions in the hands of so-called experts. However, with the wealth of information available today, we can become our own financial advisors. Online courses, investment apps, and financial podcasts empower us to make informed decisions, breaking down barriers that once felt insurmountable. As we step into this new era of financial literacy, it's essential to challenge the status quo. We must ask questions, seek out knowledge, and demand transparency from the institutions that hold our money. Why should we accept low returns when we can pursue opportunities that align with our financial goals? Why should we feel intimidated by the stock market when resources are at our fingertips? This is where community comes into play. The journey to financial independence is not one we have to take alone. By sharing knowledge and experiences with friends, family, and online communities, we can create a supportive network that fosters growth and learning. Imagine the power of a group of individuals, each armed with their own insights, coming together to create a collective understanding of wealth-building strategies. We can hold each other accountable, share successes and failures, and ultimately thrive together. So, as we wrap up this discussion, I urge you to take action. Don't let the banks dictate your financial destiny. Educate yourself, explore new avenues for investment, and make informed choices that align with your goals. If this video has sparked something within you, don't just sit back. Hit that like button, subscribe to our channel for more empowering content, and share this video with someone who could benefit from this knowledge. Together, we can dismantle the myths that have held us back for too long and forge a path towards financial freedom. Let's take control of our financial futures. The power is in your hands, and the journey begins now. See you in the next video, where we'll continue to explore the tools and strategies that can help us all thrive in this ever-changing financial landscape. Your future self will thank you. And that's a wrap. If you found this video eye-opening and helpful, I'd love to hear your thoughts in the comments below. What's your take on the lies banks tell us? Have you started exploring any of these wealth-building assets? Let's keep the conversation going. If you enjoyed this deep dive into financial truths, don't forget to hit that like button. It really helps the channel grow. And if you haven't already, consider subscribing and turning on the notification bell so you never miss out on our future videos.